Hi, everyone, and welcome to the Buffett and Beyond ETF report for June 22nd, 2024. The big question is, are we near a top in this market for a while? And folks, remember, if you want to live on this beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. And let us look at some charts, and these are the QQQs, which is the NASDAQ 100. And those are the largest stocks in the NASDAQ minus any financial stocks. And we can see we've had a beautiful run up in here. And now it looks like we're topping out a little bit. And as we come down here, yeah, we can see this black line starting to curve over. And if it curves over down below this red line, that's a sell signal. And actually, this morning we did put on some of our hedges, which I'll get to in a minute. But here we are. This looks like it wants to turn down for a little bit. And you see this line down in here. This means that when the market was overbought up in here, going up in here, and then came back down to here, and now it went up to a higher high. This is actually a lower high. So with the market going to higher highs, we are going to a lower high on this histogram down here. And also the MACD, which is moving average convergence divergence line, is the fastest line is moving down. In other words, the red line is a slow line, the black line is a fast line. So let's look at the home builders, which we've been looking at all the time because we like some stocks in the home builders, but we are seeing lower highs in the home builders themselves. And you can see we're testing down here, aren't we? Yeah. And we can see lower highs here, but we are oversold, but it looks like we might get even more oversold in here. So we have to be very, very careful here. And the transportation, we look at the transportation because how the transportations go, so does the Dow, so does the economy. And you can see the transportation. And why the transportations? Because the transportation industry moves the raw materials to the production facilities, and then the transportation folks move the finished product to the retail stores, and then we use transportation to go to the stores and get them, or the prime trucks come and get it or bring it to our homes for us. But anyway, transportation is involved with the economy, and you can see it's trying to make a bottom in here. So we just have to wait and see. But down here, we're looking at this, and the transportation index has actually, or the transportation ETF, I should say, has actually turned up. So maybe there's a glimmer of hope in here, folks. So the market doesn't look like it's going to fall apart, at least not according to this signal on this day. And then when we look at technology, yeah, we see the same thing in technology as we do in the QQQs. That it looks like it's a little top in here. And we're looking at reversion to the mean. Now, this green line is a 20-day moving average. Blue line is a 50-day moving average. And what we see is the market returns to that green line every now and then. That's called reversion to the mean, the reversion to that average. And it looks like we'll probably come down and at least test that. And we'll see what happens down here. We have that same indicator that we did on the QQQs. And when we look at the semiconductor, yeah, we see the semiconductor just kind of rolling over, already testing that 20-day moving average. Problem is down here, this intermediate term indicator is now turning down. That's not a good sign. So it looks very, very weak in here for the semiconductors. We're going to look at two of our favorite ETF portfolios. Now, our ETF sector stars, we call it the sector stars because we take stocks from our favorite ETFs. And what are our favorite ETFs? They are the ETFs that have returned more than the S&P 500 over the years. And so out of those ETFs, then we picked the 2 or 3 or 4 or 5 of our favorite stocks out of that ETF. And yeah, there's some overlap because like over here, this is Amazon, and Amazon is in most all the ETFs, most in all the indices. So anyway, the ETF sector stars are our group of stocks that we picked from our favorite ETFs. Over here, we have timing hedges. Now, we hedge up to 30% of our portfolios, this one and the next portfolio we're going to show you. We'll hedge 30%. This one over here on the right is hedged all the time. And what we try to do is outperform the S&P 500 but take less risk than the S&P 500. And you can see that being hedged all the time, we're up 14.3%. And over here, the S&P is up 14.8%. So that's pretty close. We're doing what we wanted to do. Now, when we time those hedges, we're actually up a little bit, and the total ETF with timing our hedges is up 26%. Now, if you're not hedged, we're up 28%. So we kind of like timing the hedges because we will try and catch the trends when they're going up or when they're going down. And if they're going down, then we'll hedge. And if it's going up, we either buy more stocks in the portfolio or we just buy the QQQs, which is the NASDAQ 100. They sell the QQQs at the top and buy the SQQs, which is 3 for 1. What does that mean? That means it takes only 10% of portfolio value in order to protect 30% of the portfolio. Now, some of you are in a regular portfolio where you have margins, so you can invest all your money in these stocks, and then you could take 10%, go 10% on margin to protect the portfolio 30%. So that's another way to do it, and it's kind of a neat way, by the way. So bottom line is, with the market up 14%, our top stocks that we picked are up 28%. If you're timing the hedges, we're still up 26%. So we're just about doubling the S&P 500. And we do have some hedging going on here, folks. And boy, being up 28% for the first half of the year is, you know, we used to say in the old days, if you get a 20% return anytime during the year, sell your stocks, take the rest of the time off, because there's going to be a correction sooner or later. And that's what we're looking at right now, as a matter of fact. Now, when we look at QQQs, same thing with hedging. Here it is hedged all the time, up 21%. Folks, the S&P is up 14.8%, but if you're with the QQQs, or the top stocks that are QQQs, we are up 21% if we're hedged all the time. That's very, very good. Now, if we're timing the hedges or if we don't have any hedges, we're up over 35%. You almost call it 36%. So we're doing very, very well, more than doubling the S&P. So being hedged 30% with only 10% of the money, because the SQQQ is a 3-to-1 inverse ETF. You get 3 times the bang for your buck, and they were developed for IRAs because you can't go short you can't go short in an IRA. So some bright fellows came out and gals came out with an inverse ETF. You buy it and it will act inversely to the QQ, in this case the QQQs, but we have them for the XLK, we have them for the XSD, we have them for the Dow, we have them for the S&P. So what we do is, in this case, since most of our stocks are technically orientated with the semiconductors or the techs, then we take the inverse ETF for the QQQs, which is the SQQQ. So there we go, folks. We're up 35.9% if we're timing the hedges, up 35.7% if we're not doing any timing at all, but just buy the top stocks and hold them. And folks, we're doing very, very well. So we had a pretty good week, and it looks like toward the end of the week the market wants to roll over a little bit here. So we did put our hedges back on for those of you who are timing the hedges. And I want to go back to this slide for a minute. The thing is that if you have stocks that outperform the index itself, you could be wrong on the timing of your hedges, because even if the market goes up, you're going to lose some money on the hedges. The thing is, you're making more money, almost twice as much the money on these stocks. So if the market goes up, you lose some money on the hedges, but you make, for this particular year, you make twice as much in the stocks then you lose in the hedges. And don't forget, we're only 30% hedged and not fully hedged, so it's even less that we're losing. So it's nice to have some hedge. Why do we even hedge? Why do we do that? Because when the market goes down, we'll get some money and we can cash that hedge in when we reach or think we're near a bottom and buy some more stocks. And that's how you build your portfolio. So, folks, here we are again at the beach. We had a good week. It ended a little slow, a little sloppy, but that's fine. We're doing very, very well this year, up 35%. Not bad, folks. So remember, if you want to live on this beach like Jimmy Buffett once did, then you've got to learn how to invest even better than Warren Buffett does now. So, folks, go out, clear your head, enjoy your weekend, and guess what? The market will be open Monday, and we'll be right back here with our letter, which begins on Tuesday. So, folks, we'll see you all week long. Stay safe.